Let me ask you a very simple question. When you buy shares/stock in a company, what exactly did you buy? Did you buy money? Did you buy profit? Or did you buy a business? Because many people buy shares/stock, hear that a company made profit, and still end up confused, disappointed, or even angry. In this video, I will explain ordinary shares and preference shares using real-life examples. Not accounting language, not complicated definitions. Just how this works in the real world for investors. If you want to understand what you truly own when you buy stock/shares, stay with me. When you buy shares, you are not lending money to a company. You are becoming a part owner. Think of it this way. Your friend starts a bakery. He needs $100,000 to start. You contribute $50,000. You do not expect him to pay you back every month like a loan. Instead, you now own a portion of the bakery. If the bakery grows, your ownership becomes more valuable. If it struggles, your money is at risk. That is exactly what happens when you buy shares. And this is where many people get it wrong. Ownership does not automatically mean income. Ordinary shares are what most people buy when they buy stocks. When you own ordinary shares, three important things are true. You own part of the business. Your returns are not fixed. Your risk is high, but your upside is unlimited. Let me explain with a simple example. Imagine you buy ordinary shares in a company that sells mobile phones. In the first year, the company makes profit but reinvests everything to grow. No dividend. In the second year, sales increase. Still no dividend. In the third year, the company becomes stable and now decides to pay dividends. If you needed income in year 1 or 2, you would be disappointed. But if the company grows strongly, your shares could be worth 5 or 10 times what you paid. That is the trade-off with ordinary shares. Here is something most beginners are never told. Profit is not cash. A company can be profitable on paper and still be broke in real life. Dividends are paid from cash, not profit. Let me explain. A company sells goods worth $500,000 on credit. It records profit immediately, but the customers will pay in 3 or 6 months. Right now, there is no cash. Meanwhile, the company must pay salaries, rent, suppliers, and electricity. So the board meets and says, yes, we made profit, but we do not have enough cash. No dividend this year. This is why many investors get confused. They see profit. They expect dividend. But cash tells a different story. Some people think companies that don't pay dividends are bad companies. That is not always true. Some companies skip dividends because reinvesting the money will create more value. If a company can reinvest profit at high returns, paying dividends may actually destroy value. This is why many fast-growing companies pay little or no dividend for years. Ordinary shareholders in such companies are betting on growth, not income. Now let's talk about preference shares. Preference shareholders are not chasing massive growth. They want stability and predictability. When a company issues preference shares, the dividend rate is stated upfront. For example, a company issues preference shares at $10 per share, paying 10% dividend. That means every year, the preference shareholder is entitled to $1 per share. Before ordinary shareholders receive any dividend, preference shareholders are paid first. However, this dividend is still not guaranteed like interest on a loan. It depends on the company having profits and cash. Many preference shares are cumulative. This means if the company cannot pay dividends this year, the unpaid amount is carried forward. When the company finally pays dividends, all outstanding preference dividends must be settled before ordinary shareholders receive anything. Non-cumulative preference shares do not carry unpaid dividends forward. If a dividend is missed, it is lost. Cumulative preference shares offer stronger protection. This is one of the most important questions. Will preference shareholders get their original money back? The answer depends on the type of preference shares issued. Redeemable preference shares have a repayment date. After 5, 7, or 10 years, the company repays the principal. Perpetual preference shares have no repayment date. The investor earns dividends indefinitely and recovers the principal only by selling the shares or during liquidation. This is why preference shares behave more like fixed income investments than ownership. Let's be realistic. If a company collapses, payments follow in order. Creditors are paid first. Then preference shareholders. Ordinary shareholders come last. This means ordinary shares carry the highest risk. Preference shares reduce risk, but they are not risk-free. So which one should you choose? If you want steady income and lower risk, preference shares may suit you. If you want long-term growth and are willing to take risk, ordinary shares make more sense. If you don't understand the business or cash flow, do not buy either. Buying shares without understanding how money moves in a business is gambling. If this video helped you understand shares better than before, subscribe. This channel explains business and investing the way it actually works, not textbook theory. In the next video, I'll explain why some profitable companies never pay dividends and why that can be a smart decision.